Hey guys, welcome to the intermediate video. So we're going to start off right away with the directional bias, and on the intermediate level what you'd be looking for is, instead of the higher time frames dot being open on market cipher B, how we said previously that it could be as simple as going from one dot to another dot is your open directional bias. If also you've had a candle crossing closing across the AEMA, you would then say that you are longing from dot to dot, right? So on the intermediate level, basically what changes is being aware of an anchored wave. When a wave is anchored, price usually carries on in the direction of a heavy anchor. So I'll just show you an example over here, right? So this wave, from the moment it was above the plus 60 line, it just carried on going, right? Until it started crossing back down on the plus 60 line. So all of these red dots were irrelevant. You would not then be pairing up the 4-hour 5-minute entry on these. You would wait for the wave to cross back down on 60. So all I'm saying effectively is, after a wave has been heavily anchored, it is actually the break of the anchor that becomes the dot. Okay, so you would ignore the dot if the wave is in the anchor zone, and the anchor break then becomes the real dot. Okay, because you have to wait for price to cool off and come back down. So the anchor break and then the body candle closing under the AEMA, in this case because we're looking for shorts, and then from basically this point onwards you're pairing up your higher time frame, which is the 4-hour in this case, with a lower time frame, the 5-minute, and from then you're looking for short entries. Okay, so you can see here we didn't get any 5-minute high waves plus 60 on this 4-hour candle. There was no entry. On this 4-hour candle there was no entry. On this 4-hour candle there was an entry, and later on in the video we're going to talk about regular divergences, but that would have been an entry on the 4-hour. But this would have been an entry showing that the 5-minute anchored wave is creating the wick on a 4-hour candle, the upper wick. And if we zoom into that 4-hour candle, I'll just delete this, I'll just get rid of that, you can see that that 5-minute overbought anchored wave was indeed creating the upper wick of that 4-hour candle. So that is directional bias on an intermediate level. Is not just simply looking from dot to dot or from body closes above and below the AEMA. It's also knowing that an anchored wave, you need to wait for the break back on the anchor before you can start really considering this to be a trend for that time frame pair up. So that was observation 1 for the intermediate directional bias. Observation number 2 is not just simply knowing and waiting for, I'm just going to use the weekly 1 hour for this example on your AUD, not just simply shorting from dot to dot again with the body closing under the AEMA. It's knowing what is actually causing this to catch, right? So basically the transitional period of this happening, and we'll mark out the long as well before you get the body close above the AEMA and that dot formation. You're looking at a slightly lower time frame than your higher time frame, and you're going to be looking at an anchored wave breaking anchor. So the weekly 1-hour entries we're going to marry up with a daily anchor break to be the precursor of a trend reversal, as in the weekly is starting to long when a daily blue wave has hit -60 and is breaking back up on -60. You can say perhaps the weekly is going to start longing from this point, and then you would marry this up to the start of a week. So that is a Monday when the wave has touched the -60 line and come off the -60 line, which is perfect. Monday is the start of a week, right? So if we go look at this now on the weekly time frame, you can see that that indeed was the first blue candle in this sequence of weekly candles. Even before we got the confirmation of the dot and it crossing above and closing above the AEMA, we would have only been starting to look for weekly 1-hour entries from this point onwards, which is still fine, right? You don't have to catch this candle. But if you wanted to absolutely know that the trend is reversing, that's how we would look at it. and we can just go to the short and have a look there as well. So you can see we had the anchored wave. It hit plus 60 when it was breaking back down on plus 60. You could say to yourself, well, if that marries up to Monday, let's go and have a look. Well, that's Tuesday, that's Monday, so it's intrabar on this first candle is the first red candle for the week, right? So there it is. Or you could just wait. I mean, you don't have to know about it, but it does help guide your hand when it comes to trend reversals. So here is just a quick summary of that cheat sheet. So we can go and maybe look at, let's go and look at a 4 hour, 5 minute. For example, we'll see if we're getting a 1 hour anchor break to an anchor break. So if we were starting, for example, using the basic strategy, you wanted to know that this was going to be a 4 hour short, you would then go and see if the 1 hour had a blue wave hitting plus 60, breaking back down on plus 60. Let's go and have a look. Great, wonderful, right? So there's the wave. So this is telling you we've come up, and as soon as it's hitting the spot, if that anchor break spot is aligning to a 4 hour candle close, which it is not, because I think the 4 hour candle is only closing at 4 a.m. So from that point onwards, right? So intrabar, perhaps it was breaking back, telling you perhaps the 4 hour is going to start a trend. So you missed the first candle because it's intrabar, but it happens before you're getting that dot. You're starting to see intrabar that it's coming, you know, there's a high probability that it's coming. And then you can start from this point onwards looking for 4 hour, 5 minute entries. Okay, I'm moving on to the entry section. So for the intermediate entry, I just want to talk about lower probability setups that still play out. And by that I mean, and I have actually just marked up this 4 hour sequence on your AUD since we are familiar with it now, just to show you an example. So on all of these bearish candles, we are trying to catch the overbought, the plus 60 level on a 5 minute time frame is telling us that that is the upper wick of, potentially, right, the upper wick of each of these 4 hour candles. We want to enter the upper wick of these candles and then just keep riding it with this trend to take profit. So we know that for a perfect high probability setup to play out, it needs to meet these conditions for longs and shorts respectively. It would be the inverse for longs. So firstly, because we're shorting and this is the open of one of those 4 hour candles, right? We want price to be above the open firstly. Secondly, I'm just going to pretend this candle might have grazed the plus 60 line. So let's pretend that this this wave got above plus 60 and actually hit above plus 60. It is the closest one. So we'll just say that did happen. Just for illustration purposes, that is step 2. Step 3, you want a red candle body close under the AEMA. And that would be your entry, right? So that would be a perfect sequence. 3 out of 3 on the checklist has been met. It happens sometimes that only 2 out of the 3 criteria on this checklist gets hit, and the move still plays out, and it is still an incredible move. So this is actually an example of just falling short and doing that exact thing. I'll show you the next candle as well as an example of that. So you can see when this wave was coming up, it never hit plus 60, but price was above the higher time frame open. This is a 4 hour open, right? Never had the 5 minute anchored wave, but you then did still have obviously the 8 crossing down. There's a bit of consolidation here. Let's just say this big candle rather, more confirmation. The candle crossing down on the 8 EMA, the trend is still bearish, right? It's still bearish on the 4 hour. So with the intermediate entry, if you think that there's still a chance that the move can play out, even if you don't get the A plus setup of this massive pullback, you know, that's all you're wanting. You're just wanting a bigger pullback, because then your stop is likely a lot safer when you place the trade. If you're placing it up here, if price came back up to there, your stop is a lot safer. You're probably getting more RR on this trade, potentially then a higher win rate if your stop is safer. It's just, you know, better overall, better probabilities, right? There's a higher probability setup when the wave anchors. But if the wave doesn't anchor, it can still play out. And as an intermediate strategy, if you are still prepared to take the risk of that happening, then of course you can just enter with 2 out of the 3 criteria, perhaps risking less per trade. If you usually risk 1%, then maybe risk 0.5% per trade, right? that's just an idea. Or you could even sell stop the open of the candle if you still expect this 4-hour candle to close bearish, which it did. The close was down here, right? So you could always sell stop the actual open price of the 4-hour candle if you don't have time to wait for these waves to hit plus 60. If you're happy with only having 2 out of the 3 criteria, because on the 4-hour we are still very much, let's go to that move. So this is the move, right? This is the candle. It's only just started going under the 8 EMA. It would have to circle all the way back even now, right? It's hitting negative 60. And like I said to you, sometimes when a wave gets anchored, it actually carries on in the direction of the anchor for quite some time. So you know that you've got quite a bit of time for this to catch up. So if you didn't want to leave any money on the table and you didn't want to waste the opportunity of the 4-hour still trending, then as an intermediate entry, you can still take the lower probability setup of not having the deep pullback, and you can possibly just risk less on this type of a trade and still get something for it. So we're going to be moving on to the take profit section. I'm just going to carry on with the 4-hour 5-minute example because we're familiar with it now. It looks like all of the 4-hour and 5-minute entries in this sequence were those lower probability 2 out of the 3 points in the checklist were being met. But that's fine. If we're happy to take that risk, you just risk less. That's up to you. Risk is a very personal thing. We can talk about risk management in the advanced video. So in terms of take profit, your lowest hanging fruit is always that once you enter, you want to break structure on your left. But what we like to do is not only just break structure on the left, we like to have structure broken with an anchored wave on the same time frame that we're entering on. So this is a 5-minute entry. So this is how that would look. So if you're breaking structure to the left and getting an anchored wave on the same time frame that you're entering on, that's how that would look. This one, breaking structure on an anchored wave, that's how that would look. Breaking structure, anchored wave, right? So that is your absolute lowest hanging fruit, your take profit 1, if you want to call it that. I know people talk like that sometimes. So it's your safest, like, let me just get some risk off the table type of a take profit. The second type of take profit then is if you know that this is a 4-hour candle, right? That's a higher time frame pair up. Each of these is a 4-hour candle. You can, in some instances, say, I've entered, I know that this candle is going to close bearish because this is my directional bias and my trend. I don't know how small or big the candle is going to be by the time it closes, right? So what you can say is, I'm just going to hold it until it closes. And that could be another take profit point for you. In this case, you were worse off. Let me just move that down. In this case, you were better off, right? Using the time of the higher time frame candle. In this case, you were very much so better off, okay? So that is another way that you can look at the take profit, is just using the close of your higher time frame candle, because you know that that is your directional bias. You can hold it all the way up until the close because you expect it to close red or blue respectively, and if you are using the higher probability setup, you've entered on the wick of that candle. Why wouldn't you ride it to the close then, right? Lower probability setup, you're entering on the open of that candle, but still you can ride it to the close and you should have something for your trouble. Only time it's going to be a bit horrible is if the candle's a bit of a doji. This would probably be a very small candle. We can go and have a look at this one on the 4-hour and see actually what it looked like. So it's a very blocky, stumpy candle, not really a doji, but yeah, like these sort of candles it's not going to be great, but you're not going to lose the trade either. It's just going to be a re-roll, reset, go again type of vibe. And then these two are obviously, the meat and potatoes of your trading. All right, and we're going to talk about one risk to this strategy, being aware of the risk so we can solve and overcome the obstacle, so that we can increase our win rate. And I'm just going to be using AUD-CHF on the daily time frame here. This was one of the calls I actually put out in the Discord. You can see clearly that the daily time frame is trending. We're well above the 8 EMA, open dot, all that strategy, broken anchor, cool. So we're looking for to catch a 15-minute oversold, so a negative 60 wave, creating the bottom wick. Let me just delete these quickly. creating the bottom wick on the daily candle. We want to enter on the wick and ride the candle to its close or more, right? So I've marked these up. We're going to go back to the 15-minute time frame now. Okay, so here are our steps. This is one daily candle. This is another daily candle. So what we want is, again, price to be below the open. We want the entry time frame, the 15-minute time frame, to hit -60 convincingly under, not just grazing the line, convincingly under. And then we want to have a blue body candle closing above the 8 EMA. That's your entry. I called this entry out 3 days before it happened in our Discord, and I think some of the members caught that, so that was exciting. This entry was really clean, really perfect. So you know, everything happened in sequence as you would like it to. Is honestly a perfect D15, right? Unfortunately, this doesn't always happen on entry. Sometimes we can be faced with the risk of regular divergence could occur on the entry. So what that would look like, I'm just going to draw it over here. You would have this wave breaking anchor. You would have another wave just below zero, and then it would cross up. Okay, this shoulder or trigger or whatever type of wave you want to call it, it can sometimes create a regular divergence before the price actually moves on. And I'll show you an example of that. I'm just going to show you the most recent example of a trade that I also put out in the Discord. It was for a weekly 1 hour time frame pair up. I have been waiting for this trade since Sunday. It is Thursday now, and I missed the trade, and I'm going to show you why I missed it. So you can see that the weekly open green dot has broken anchor, broken on the daily wave as well, suggesting that we're coming up, right? So body candle close above the 8 EMA, we're trending up. I wanted to catch that bottom wick right there and ride this candle up, and I wasn't able to catch it because of the risk of the regular divergence on the entry. So let's mark it up and let's move down to the 1 hour time frame, and I'll show you just that. Right, so here is the start of the week. We're still busy. The week candle has not yet closed. It's non-farm payrolls tomorrow. I bet this comes off that. Anyway, not in my place to say right now. I'm obviously salty that I missed this trade, but anyhow, let's carry on with this. We wanted price to be below the open. We wanted the 1 hour, which is the lower time frame, to hit the oversold -60 level, hitting anchor, because this is with a high probability creating the bottom wick of our weekly candle. You can see that it was a really ugly regular divergence on the entry, right? And that's exactly what I was talking about. And it didn't really go deep enough below the open to be a convincing, tick off my list. For me, I wanted this to be much deeper below the open. It didn't go that way. But let's just say hypothetically you entered off this anchored wave and then the cross up on the 8 EMA. If you were very tight with your stop and you were just swinging right under that structure, you can see that the regular divergence would have stopped you out. Okay, that's what I'm talking about. That is the only risk on entry with our strategy. So being aware of the regular divergence, you can either wait for it to occur if you think it might. The problem is it doesn't always. As I showed you with AUD CHF on the daily 15, that was a clean play. And a lot of the time they are clean plays. So if you're waiting for a regular divergence, it doesn't happen, and then the move goes without you, well, you've missed it, right? I missed this one because I wasn't happy that the pullback under the open was very shallow. If once the regular divergence is played out, that's really when you should be entering the trade. At that stage, at least you've got that to swing under. It was still a perfect trade anyway. What you could do is, if you thought that there's going to be a regular divergence, you could always just give yourself a much more generous stop to try and accommodate it. If you are very certain about your directional bias, which we usually are, even though everything's probability, directional bias is probability, the entry is probability, but we have a high degree of confidence of how to select the directional bias and the entry for our edge. So yeah, that's the only thing you have to be aware of, is either you can wait for this regular divergence to play out And if it is going to play out, then at least it saves you a potential stop out, or you could just make a much larger, safer stop to accommodate any potential regular divergence. So it doesn't always happen, but when it does, it's extremely frustrating because, you know, like I say, obviously it was a perfect move anyway. Alright guys, that's it for the intermediate video. I will see you in the advanced video. Thanks so much.